In this chapter, we're going to talk about managing your credit, and we're going to first start by concentrating on talking about credit cards. In another video, we'll continue this chapter, but in that, we'll talk about how you can get rid of credit once you have it. How do you get out of debt, in other words? So let's go ahead and start with this chapter. We're going to talk about credit cards. Obviously, there's some advantages to having a credit card. If you can make the payments every month, you have some free financing. You get a statement, of course, for you to do some record keeping. And if you have a credit card, you don't need to have cash. On the other hand, on the downside, sometimes you might make some purchases of things that you don't really need, can't afford. You can spend beyond your means, of course. And any excess spending can continue when you, with what we refer to as minimum payments. And we'll talk about these a little bit later. But I mean, obviously, the biggest challenge with having a credit card is understanding the difference of buying things you want versus buying the things that you need. And if you're buying more things that you want, this can lead to overusing credit cards. So how does a loan grow? I mean, this is a typical kind of a credit card here that has an interest rate of 1.5% per month. Now, if you do that calculation real quick, that's an 18% annual interest rate. We'll talk about these a little bit later, but most credit cards from a bank are going to be in that range, probably 18%. But when we talk about credit cards from retail operations, such as having a JCPenney card or a Best Buy card, or some of those things that are identified that you can only spend in a retail store, you can pay 25 to close to 29%, I think, is the maximum. So, I mean, it can be quite heavy interest charge. This just shows how the time value of money on a monthly basis can get a credit card to grow very quickly if you're not trying to pay it off every month. So again, it obviously grows pretty quickly. So when you apply for a credit card, how do you do that? Most of the time, you have to fill out some kind of an application. And then the way they do this is something referred to as credit scoring. So every answer that you have on this application, most every answer, has some form of a number that goes along with it. So if you talk about how much cash you make, your credit history, right? All of these things have influence on you being able to get a credit card or not. So they'll ask you questions, right? Do you have a job? If you don't have a job, that's obviously bad. If you have a job, that's good. How long have you worked there? They'll ask you about your income. Where do you live? Do you rent or do you own a home? So all of those questions identify and are ultimately quantify your financial standing, if you will. Obviously, they're going to do some kind of a credit check, so we'll need to know something about your FICO score. Other things that obviously they'll look at, they're going to look at your existing debt. This is all part of this credit check that they do on you when you apply for a credit card. So what types of cards? We've already mentioned these. MasterCard, Visa, and American Express are the most frequent, most popular, I guess you could say. MasterCard and Visa allow some financing. That means you can actually maybe get a cash advance if you need it. Most American Express cards require some type of payment in full. So you have to really look at the rules when you want to get a credit card. And American Express cards are not as popular as MasterCard and Visa. I mentioned a little bit earlier the idea of a retail credit card. And again, the problem with these is the extremely high interest rate. Now, what they'll do is they'll say, when you go into a store, almost any store that has these credit cards, I mean, they'll offer you a credit card and they'll give you something for free, right? So maybe they'll give you a cup or a pen, or maybe they'll give you on this purchase, maybe they'll give you 20% off. But then they're going to charge you monthly. Again, we talked about the interest rate. It could be high as 29%. Again, even if it's 24%, right? That's 2% a month is what you'll end up paying. So they're very expensive forms of credit. I'm sure everybody understands what a credit limit is. That's the maximum amount you're allowed to borrow using a credit card. Now, if you exceed that, there's some charges that will be there. Sometimes you can use, if it's a bank credit card and you have a checking account at that bank, sometimes they'll allow you to use the credit card to cover overdraft protection on your checking account. And sometimes you can also go beyond your credit limit, but there's going to be, you're going to have to pay down pretty quickly after that. Some cards have annual fees. Some have incentives, right? So they talk about the prestige cards, where this is just the platinum cards, etc. But when I think about incentives, I'm thinking about the mileage cards, right? I forget what it is, Capital One, right? You get money back on every purchase. Well, I mean, yeah, you're getting some money back. You're getting 1%, but then they charge you 30% in interest. So you do have to understand that, you don't get anything for free, right? The incentive is to get you to borrow to a point where you can't pay it back at the end of the month, so that they can charge you a higher interest rate. Typically, there is a grace period, but not all that prevalent all the time, right? Usually, the day that it says that it's due, you have to have the payment in there, and it has to close or clear by the end of business that day. So a grace period could be there, but it's not real popular, if you will, for having that on a credit card. If it doesn't close by the day that it's due on the statement, there's going to be a fee. And of course, there's an interest rate, right? Now, there's regulations on the interest rates, but how that works and the actual limit to what they can charge is very high. Most of it is variable, actually. So the interest rate is typically some number, and then they add to that maybe 10%. So typically what they've used is what's called the LIBOR rate. That's the London Interbank LIBOR. I don't know what the OR stands for, but anyhow, it's LIBOR. And they take that rate and they add a certain percentage to it. It's kind of like thinking, if you've ever heard anybody talk about, you get a prime rate at a bank, it's prime rate plus something. And that's typically the way it works. So it is variable. As interest rates change, your interest rate itself can change from time to time. Now, one of the things that you can do is you can take something called a cash advance. So you can go and say, I need $500, and you put the $500 on your credit card, right? So essentially go to an ATM. Now, it's not an ATM card. This is a credit card. The money comes out. It's a cash advance. Typically, there's a fee on the cash advance, and sometimes the interest rate on the cash advance is higher than the interest rate if you'd just gone out and used the credit card to buy something. We've talked about finance charge. Obviously, that's the interest that you have to pay. And there are several ways that this is calculated. It can be calculated using something called the average daily balance method. They say here it's the most frequent. And essentially, they calculate the average daily balance at the end of every day in the billing period. And then they calculate the interest based on that. The previous balance method, this is charged on the balance at the beginning of the new period. And the adjusted balance it's charged based on the balance at the end of the new period. So there are several ways, and there are actually some other ways historically that you could have that they could have used to calculate interest. I believe most recently they've gotten rid of some of those balances or some of those methods because they essentially magnified the time value impact of owing interest on credit cards. There's a video here called Calculating Interest. It's only about 6 minutes. I suggest you watch it. It gives a pretty good example of how interest is calculated and why it's important to make as big payments as you possibly can. Interest can be simple interest. It's the percentage of credit that has to be paid as interest on an annual basis. They also talk about something called annual percentage rate, right? Essentially, the annual percentage rate allows you to make comparisons between other lenders. So if you have an 18% APR, you take the 18% and you divide it by 12, and that's the interest rate that you're charged every month. But let's not forget that there is compounding. So if you don't pay it off every month, the principal or the interest on that is also going to grow. It's now part of the loan. So you have to be willing to pay off as much as you possibly can every month. So I think it's we understand a little bit that there is an impact of interest rate, right? So the larger the interest rate, the higher your payments. The longer the period, of course, the greater total interest that you'll ultimately pay. So we want to understand, how does this work? What happens, when you get your bill, right? Obviously it's sent at the end of the billing cycle. There's lots of information that you're provided, but this is something I think that's kind of important. And that is this thing called the minimum payment, right? They tell you what the minimum payment is. Now, the minimum payment is a fraction of what's really owed on a monthly basis. A new thing that they've added says, look, if you make the minimum payments, how long does it take to pay off this debt? They also then will tell you, look, if you don't borrow any other money and you make this payment, this is how long it will take to pay off in 3 years. Now that's something that's new. But if you're only making the minimum payment, this time to pay off the debt, again, assuming you don't borrow any more, could be anywhere from maybe 10 to 18 years. So the interest and the minimum payments are not geared towards getting you out of debt quickly. So you have to be if you're going to carry a balance, it's important for you to know what it's going to cost and how long you're ultimately going to be in debt. It's a very important aspect of having credit cards. So I think hopefully this makes a little bit of sense, this last slide here. You should always look at your statement for errors. Make sure that the items on there are the things you've actually charged. Dispute any errors that are in there. You still have to pay the correct charges, though. Anything that you dispute formally by calling the credit card company, telling them that you didn't make that statement, they will take that into account. but you still have to make the payment that you owe. You can't skip a payment because you're disputing what you owe. If it turns out that you're correct and they agree, then in the end, you will be credited that money back because obviously it was, in quotes, a fraudulent charge. And every bill has a customer service number and or a way to dispute instructions. They're on every single one of these statements. So again, credit cards, there's not a lot going on, right? You need to, if you use them, you need to understand the cost of using them, right? You have to understand the process of getting out of debt once you're in debt. That's what we'll talk about in a future video. How do you get out of debt once you're in debt? Talk to you soon.